Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you today, and as always, we will be taking your questions, so make sure you send those to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com, for times and availability of all of our TV and our radio shows. And also you can send them for free instant email alerts about investment topics I'll be talking about. You can send questions through our website. And if you'd like to talk to us about managing your money, you can also sign up for a consultation via ReznyWealth.com. You know, we're firmly into the second half of 2021. And of course, COVID's come back a little bit. There's talk about that. And we've had a lot of questions from investors. How's that going to affect the overall U.S. economy? And should I be making changes to my portfolio and things of that nature? Now, first off, one of the things I want to stress is this. As a fee-only fiduciary money manager at Rezny Wealth Management, we actually manage portfolios. So we don't sell investment products like a bank or an insurance company or an advisor. We're an actual money manager, and we legally work for the client 100% of the time since we are fee-only fiduciary. One of the things that I try to teach every single investor is do not put up with mediocre advice, because too often what I find with investors is they continuously put up with this mediocre advice for years and years and years, and they don't do anything about it. Mediocre advice, conflicts of interest, cost you your retirement and your investment portfolio dearly. No investor should ever put up with mediocre advice. If your investment returns are subpar, if you're realizing your advisor is really just a salesperson working, for the big bank or Wall Street firm, nice person, but they're not doing anything for your financial security, it's time to kick mediocre advice out the door and find yourself a fee-only fiduciary money manager, not an advisor. Conflicts, being sold inferior investments, rob your returns in retirement. Things like annuities, which I talk about repeatedly, how garbage and junk annuities are to you investors. Sad fact, I would say more than half investors nationally have been sold at least one annuity, some 4, 5, or 6. I'm yet, in 30 years plus of managing money, found a happy investor who was sold an annuity. It usually takes most of you about 4 or 5 years till you realize what you were promised isn't right. But that's just annuities alone. There's direct participation programs from brokerage firms, non-traded real estate investment trusts, certain mutual funds, load products. There's a lot of investments out there, quite frankly, that are manufactured by these firms in order to line their pockets more than yours, and that's not right. The other big issue for you, the investor, simple. It's called procrastination. It's costly, and your wealth and financial security could be at risk from procrastination. We're all busy. We all want to wait to see if things get better on their own. But let's face it, the longer you procrastinate, the more it's going to cost you. It's kind of like when to sell an investment. One of the big questions I often get on my TV and my radio show is, Brian, I bought XYZ investment, but I never seem to know when I should sell it, either at a loss or at a gain. Again, this is procrastination. Part of your investment strategy should always be a lot of daily research, and part of that is, when do I sell something that I've actually purchased? The longer you wait to make a decision on something that should have been sold maybe months ago, you might end up losing 50% on that investment because of, again, procrastination. Remember this, the investment relationship you currently have, if it's mediocre, if it's full of conflicts and added cost, and you wait to find a better situation for your personal financial wealth, that's procrastination, and it's going to cost you in your financial security. Hire a real money management firm. I've talked about that repeatedly over 30 years. To manage your wealth, not sell you investments that person is required to sell through their brokerage firm, bank, or insurance company. Real money management firms do exist. In our opinion, about 10% of firms nationally are fee-only fiduciary money management firms. That leaves well over 90% of these other so-called advisors, brokerage houses, banks, insurance companies, are really sales organizations selling products that are not as good for you as it is for them. Those added costs, those conflicts, again, rob your hard-earned money and your retirement security. That's sad. Never settle. Never put up with conflicts from a so-called advisor. You don't have to. Go to ReznyWealth.com. Click on any of our free groundbreaking reports. It'll educate you how to find a real firm, how to check out the firm you currently have. Go to the SEC site or the FINRA site. Make sure the firm you entrust your money hasn't been fined billions of dollars repeatedly year after year for misdoings against you, the client. Again, that robs your financial security. By the way, if you want to learn more, go to my website. Click on our workshop tab. We have upcoming workshops every month. You can sign up and they are free. They will be groundbreaking and educational. The disturbing facts most investors are shocked to learn. Learn from others' mistakes. That's what I'm going to teach you. I'm going to teach you how to avoid the conflicts, the bad advice, and the major investment pitfalls that too many of you investors and retirees make every day. Again, learn from others' mistakes. It's going to be way less costly for you. To find out about our upcoming workshops, times and availability, and to sign up, go to ReznyWealth.com and click on that webinar tab. I'm going to go to my first question. Tammy in Naples, Florida. Is Europe on the verge of a turnaround? Would you invest there? Tammy, that is an excellent question. First off, I would not invest anywhere currently outside the U.S. In our opinion and from our research, I firmly believe the best place to be invested right now is in the U.S., whether that's bond related, equity or stock related, or other types of investment related. Europe, first off, has been in and out of recessions repeatedly for decades. Every year, year and a half, it seems they go into recession, they come out. Their growth is never great. Europe's kind of like this socialist experiment from the EU. I would avoid Europe at all costs, and if you owned outside investments in Europe, I would be looking at selling those and upgrading your portfolio to greener pastures. The U.S. marketplace, in my opinion, is still the best place to invest. If you looked at recent things that are going on with the emerging markets, specifically China, look what's going on with China. China is cracking down on their own companies because they want to have even more control. What's happened to the Chinese market? It's plummeted. That includes a lot of these emerging market investments are down 15, 20, 25% in the last couple months alone. But you probably have those in your portfolio, a lot of our listeners on the TV show today. Look at your brokerage statement. Again, your advisor is selling you things that maybe isn't the best for your portfolio. I would continue to avoid Europe, and I would continue to avoid the emerging marketplace right now. But make sure you do go to ReznyWealth.com. You can also send your questions for the TV show to Brian Rezny at ReznyWealth.com. We love to get your questions. We want to give you the advice you need so you can make better decisions around your money, and that will help build a more secure retirement for not only your portfolio, but for you and your loved ones. Sam in Naples, Florida. Are rising interest rates bad for stocks? Not necessarily, Sam. The big scare that a lot of people have had is rates are going to go up a lot because of inflation. Our opinion, and I've talked about this repeatedly, I think there's a chance in the next couple years, not this year, probably not next year, but over the next couple years, rates might go up a little bit based upon if the economy is really chugging along. But I think ultimately the Fed will not raise rates much at all. I think we're going to be in a low interest rate environment for almost ever, maybe a little higher than interest rates are today, but not a lot. I don't see interest rates going up on the 10-year to 4 or 5% at all. Inflation is a little out of control on some aspects, but not all aspects of the economy, and some of it will be transitory, but again, some will be permanent. But ultimately, if the Feds raise rates too much, it's going to be very difficult for the U.S. or other places of the world to pay their debt because of those higher rates. I think we're in a permanent or a long-term interest rate freeze, and I think rates will stay low, so you income investors are going to get hurt badly. You need to look for alternatives, and I think the equity market specifically in your overall portfolio is one place to look for total return, income, and growth in combination. Folks, I have to take a quick break. I'll be right back with more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Hey, I hope you're enjoying today's program. We're taking questions. Send them to Brian Rezny at ReznyWealth.com. Jim in Marco Island, Florida. How could the recent election affect the markets? Are you making big changes to your client's portfolio? Jim, the overall election really that occurred last year, and of course, we've got the midterms coming up next year, in our opinion, are not going to have a big impact on the overall market, the stock market. You have to remember, whether it's a Democrat in office or a Republican, they both spend money. So that's just the fact. Now, the Democrats, of course, are pushing hard for their infrastructure bill, and there'll be different versions of this over time. Who knows what's really going to get passed, how much additional they'll add when it does get passed. So these are all things that are in the working progress. We do need real infrastructure in this country because it's been lacking for decades. And again, spending money, growing the economy is good for the overall equity-based markets. Probably our biggest concern overall is really if we really had hyperinflation, which I don't see us having. We've got more transitory inflation right now because of all this pent-up demand from last year for money that wasn't spent, added stimulus this year, and that's one of the reasons there's not enough supply and there's a lot of demand. That does push prices up a little bit, but it should be somewhat muted, hopefully, as we get into 2022. Brad in Naples, Florida. I have a large allocation to cash as I was unsure about the past election. That proved wrong. What would you do now? Brad, first off, one of the things that I try to educate every investor, try not to put your personal opinion into your investment process, like elections. I couldn't even tell you, 40, 50, maybe 100 questions that I've had submitted for my TV and radio show over the last year or so, just like what you're saying. I'm concerned about the upcoming election. I'm going to cash, things like that, or should I raise cash? At the end of the day, if you're worried about an election, you haven't done your proper homework, and your portfolio is not properly allocated. So what I'm going to say is this. The economy is going to grow. As long as you are a longer-term investor, and long-term to me is 3 years or more, meaning money you don't need today for immediate income. So whether you're 90 years old, whether you're 40 years old, or somewhere in the middle, and it's money you don't need to spend all in the next 3 years, most of your money then is probably long-term investment, and it should be allocated and invested that way. When we look at the markets, Brad, sure, we do look at which political party is in office, because that will have some impact on areas we might invest more or might invest less. But just because there's a Democrat or Republican or somebody you don't like in the White House isn't a reason to go raise a bunch of cash. You want to look for the different avenues that you should allocate that money that may be beneficial based upon where they're going to spend that money going forward. I hope that answers your question. By the way, if you're like Brad and you're concerned about your overall either a portfolio, maybe the current relationship you have is just not working, or you're having those second thoughts or doubts about that person, I've got an upcoming workshop. You can go to our website for times and availability. The disturbing facts. Most investors are shocked to learn. What I'm going to teach you is you're going to learn from others' investment and retirement mistakes so you don't make those same investment and retirement mistakes. It's cheaper that way. I'm going to teach you the pitfalls I find a lot of retirees make with their portfolio. I'm going to talk about the biggest risks you have right now to not only your investment portfolio, but what you should be doing with your money currently as we continue to go through this year. Go to ReznyWealth.com. It has the dates, the times, and how to sign up when you click on that workshop tab. And trust me, it'll be one of the best educations you ever get about not only your retirement planning, your retirement in general, how to build more financial security, and how to properly invest your money instead of taking the conflicts and risk of a so-called advisor. Again, go to ReznyWealth.com, click on that workshop tab. Fred in Fort Myers, Florida. I'm currently managing my own money and I'm having a tough time making investment changes. Do you have any recommendations? Fred, great question. First off, if you're having a tough time making changes or deciding what to do, maybe you don't have the skill set in order to manage your own money. Again, I've been managing money for over 30 years. I have a staff. We spend a lot of money on research. We manage portfolios, large and small, every single day. We have the experience. Some people, and probably half of our new clients, by the way, come from people like you, Fred, who tried to manage it on their own and just didn't know how to do it or were just not good at it and realized they needed real help. Managing money is not easy because what I find often is most investors don't have the time, discipline, or talent in order to do it. And they often make emotional decisions, which leads to severe downward pressure on the portfolio, loss, mediocre at best returns. So Fred, if you're having doubts and you can't make decisions now, it's not going to get any better, especially if you get a more volatile market, which we may get sometime this year. What I would suggest, Fred, if you've got a larger portfolio, call my firm for a consultation if you'd like to discuss our services and how a real fee-only fiduciary money manager can work in your legal best interest, manage your money professionally, take the sales part out of it that you're going to find from those Wall Street firms and banks, and actually work for you 100% of the time. Go to ReznyWealth.com, Fred, click on our consultation tab, or go through our website and learn more about our firm, our approach, and how we can ultimately help you and your family create that financial security that you so desire. Mel in Cape Coral, Florida. I own gold and silver coins bought many years ago from a commercial. I recently realized these coins are way under water in value. What would you do? First off, Mel, let me tell you what happens. I will say that I have probably talked to 1,000, 2,000 people in the last 10 years alone on my TV or radio shows. I get these questions all the time. People who buy gold from these commercials or buy these gold coins or silver coins. First off, never buy gold or any kind of currency from one of these commercials. These people are selling you a bag of goods. Gold coins and silver coins are probably the biggest ripoff there can be in investing. These things are highly marked up. They'll show you a coin, but they'll sell you something else. Markups on a lot of these gold coins and silver coins often can be 1,000 to 3,000%. They promise you the sky. They talk about the coin that went up 1,800% in 10 years, but it's not the coin that you own, and it's not the coins they're going to sell you. So at the end of the day, gold and silver coins are a bad investment for 99% of investors unless you really understand that business and you can buy them at a discount. Most investors do not have the ability to do that. Unfortunately, too many of you get suckered into these commercials with some celebrity selling you gold and silver at inflated prices, and it's going to cost you dearly. With that said, though, I'll leave you with this before I take a quick break. What's interesting is we would get a lot of calls in the last couple years about buying gold and mega inflation. What's interesting, think about it this year, folks. This is supposed to be the year of higher inflation, which we are seeing, by the way, but not hyperinflation, but certainly higher inflation. The money printing presses are going. So there's a lot of issues going on. These commercials told you to buy gold. Guess what gold's done year to date? It's negative. It's lost money. even though other asset categories are ultimately doing quite well. So gold is not really a great inflation hedge. One of the better inflation hedges statistically is often oil, just to give you an idea. I'm going to go take a quick break. Send your questions to Brian Rezny at ReznyWealth.com. Visit our website, ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not fee-only fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. And we're back. Tom in Punta Gorda, Florida. You were spot on with your advice on small cap stocks the last few years. What overall returns do you expect from small cap versus large cap in the upcoming years or going forward? Tom, excellent question. So basically what happens is this. Anytime you have a recession, which of course we had last year, often what happens, small caps get hit much harder than large caps do. Not a guarantee to the future, but often what happens by putting small cap into the portfolio after a recession, you often get 12 to 24 months outperformance above and beyond what large caps have provided. Again, not a guarantee to the future. We still like small cap currently. We still think it's a reinflation trade as the economy comes back to full vigor. So we think there's some excellent opportunity in small cap still. Don't overload the boat. Depending again on your risk profile, your goals and objectives, and your timeline, you may want to have between a 5 and a 10 or 15% allocation to small cap. Again, stay within the U.S. marketplace. We are not invested currently at all overseas, especially Europe is just a dump of a place to go and invest. Returns, in my opinion, are going to be lackluster. Risk is high. Stay in the U.S. place. But again, we still like the U.S. overall, and we do like small cap for the foreseeable future. Great question, though. Larry in Naples, Florida. What exactly are moving averages, and are they useful tools when making investment decisions? You know what, Larry? That's called technical analysis. And yes, charts and moving averages can be quite useful. We use both. We use fundamental research, which is like lifting up the hood, looking at that car engine, making sure all the spark plugs are there and everything's plugged in correctly. And then what you do is you kind of back that up with moving averages and technical charts. What moving averages do is gives you kind of a picture, mind you, of the direction of different asset categories that you may be considering. Usually what you want to try and do is look at a moving average, look at areas of resistance, overbought conditions, and buy points on a chart. This can be very useful, not a guarantee, but it can be useful in buying dips that are temporary, that may give you more upside potential. And it also might be a great tool to utilize when you may want to sell a particular investment when it's going down before it goes down too far based upon those overall moving averages. But great question overall. Charts can be helpful, and I think it's something you have to have in your toolbox. By the way, Larry, if you want to learn more about investing, I have an upcoming workshop, The Disturbing Facts Most Investors Are Shocked to Learn. What I'm going to teach you folks, learn from others' investment and retirement mistakes so your investment and retirement portfolio is not devastated. One of the things that I often try to teach every investor, the pitfalls to avoid. Remember, it's a lot cheaper if you learn the pitfalls and the mistakes that other people make in their retirement. It's less costly to your portfolio. If you learn some of the fact-based investment strategies, if you learn how to check out the advisor firm that you entrust your money, maybe you've never been to the SEC site, maybe you want to learn more about technical trading or how the economy is moving, our workshops are a great opportunity for that. Go to ReznyWealth.com, click on the workshop tab for times, availability, and the sign up. Mike in Miami, Florida. What is your view on the equity markets? We like the equity markets, Mike, in the U.S. One of the things I've said repeatedly during this show, and I've actually talked about this the last couple of years, stay out of Europe. When we get new accounts that come into our office every single month, we look at those statements coming from those other firms because people are not happy. That's why they come to Rezny Wealth Management. They want a difference. So we review what's going on in the current portfolio. Mike, you know what I see all the time, even today? A lot of Europe, a lot of international investments in that portfolio. When I talk to the investor who's looking to hire my firm to manage their money properly, you know what they tell me? Well, we brought this up to our advisor repeatedly over the years, and they always poo-poo saying we should be diversified. Mike, you could be diversified in the U.S. You don't have to invest overseas. So again, the equity markets look promising. We're going to probably get some volatility this year like we do every single year, but in the next 3 to 5 years, I see greener pastures overall. Tom in Naples, Florida. What is the role of bonds in a portfolio? Do you believe in the weight of bonds based upon age? I'm 65. Bonds in a portfolio can help reduce some of the volatility of the equity part of the portfolio. Some. But I will tell you, bonds are a game changer going forward. We have rates that are basically at historical lows or darn near lows. You're not going to get the protection from bonds you once did 10 years ago or 20 years ago, folks. That's a problem. I never, Tom, believed in age-based on bonds. What that means, folks, all the brokerage houses and banks push this all the time. They tell you should be allocated based upon your age to bonds. So if you're 60, you should have 60% in bonds, 40% in equities. That's kind of how they work it. And as you get older, more should go in bonds. I do not believe in that. If you do that, in my opinion, you are making a devastating impact on your portfolio, and you are not going to be a happy investor overall. So what I will tell you is this, Tom. If your portfolio is based on age, based on bond allocation, you're making a big mistake. You need to rethink your portfolio and the investment strategy. We like what's called total return. Growth, dividend, income gives you a combination total return. Bonds are not going to cut it, and they're not as safe as they once were, and they're not going to give you the protection that people think they're going to give you in a down market overall. Terry in Boca Raton, Florida. What do you think about all the negative bubble headlines you hear every single day? What should an investor do? I'll tell you, Terry, ignore mainstream media news about all the stuff going on. Everything is hype when you listen to most of the news broadcasts from these financial talk shows. That's sad. You as an investor have to realize, take the negativity out, do real research, and base your portfolio based upon real research. Folks, I'm close to out of time. Go to my website, check out our workshop tab. Disturbing facts most investors are shocked to learn. Upcoming workshop. Learn from others' mistakes so you can profit and hopefully protect your portfolio. Go to ReznyWealth.com to sign up times and availability. And as always, visit our website, ReznyWealth.com. If you're tired of bad advice, tired of conflicts that undermine your financial security from that so-called advisor, sad fact, most advisors are really salespeople peddling products, inferior products that are better for them than for you. If you've got a larger portfolio, call my firm during the week, Rezny Wealth Management, Fee-Only Fiduciary Money Management. We actually manage your wealth, and we legally work for you. Go to ReznyWealth.com, and we'll see you next week.